So let's understand what happened here. Let's try the same thing that we did before. You buy the stock right now, you sell it 1 year from today, and over the course of the first year, you receive the first dividend. Let's see your two sources of income. Dividend yield, we defined it as how much you get relative to how much you pay. D1 is equal to $2.60. Here it is, that's D1. Divided by P0, which is roughly $54.11. Here it is, $54.11 roughly. Gives you 4.81%. Capital gains yield, in this case, it is not equal to G. I repeat, it does not equal to G, simply because there is no one G. There are two different G's here. There is the first growth rates of 30%, and after that 6% then after. So it is not equal to any one of them. It is simply the complement to KS. If we know that KS, the required rate of return on the stock, is 13%, then we need to subtract the dividend yield of 4.81, and therefore you get 8.19%. Notice that in this case, when you have different growth rates, the capital gains yield will not be equal to G, and the dividend yield is also something different. Let's see another example, or in fact it's the same example, just different numbers. So you can think about a different scenario. Let's imagine a company that right now doesn't move at all, does not grow at all. Maybe because the economy really sucks. Maybe because the company itself has nowhere to expand. So growth rate is expected to be 0 for the next 3 years. After that, the economy perhaps will start to pick up, and then the growth rate will be 6% from now on forever. Same KS as before, same D0 as before, $2. Let's predict the future dividends using the growth rates. So with a growth rate of 0% over the course of the next 3 years, D1, D2, and D3 will also be exactly the same as D0, which means $2. D4, however, will start to grow. You multiply D3 of $2 times 1.06, and then you get D4, which is $2.12. Fine. Let's discount only D4 based on KS minus G. So that's the Gordon model, which is applicable only from this point on, simply because only from this point on, the growth rate is fixed. So D4 divided by KS minus G, you get that P3 is equal to $30.29. And then we have to manually discount each and every cash flow separately here to present time. D1, $2 divided by 1.13, you get 1.77. D2, $2 divided by 1.13 square, you get $1.57. D2, $2 divided by 1.13 to the power of 3, you get $1.39. And also P3, the price of the stock in year number 3, which is $30.29, discounted to present time or divided by 1.13 to the power of 3, you get $20.99. Finally, you need to add all of those numbers, excluding, once again I repeat that, excluding D0, you do not add it. So 1.77 plus 1.57 plus 1.39 plus $20.99 will give you $25.72. This is the current stock price valuation, P0. It's the present value of the future cash flows. Once again, let's take a look at the two sources of income. Dividend yield in the first year. It is D1 divided by P0. D1 was $2. Here it is. Divided by P0, $25.72. Here it is, $25.72. So this will give you 7.78%. That's one source of income. A second source of income is the capital gains yield, which is the complement to KS. Both of them, they have to match to KS, the required rate of return on the stock. So KS 13% minus the dividend yield, here it is, from the first year will give you 5.22. Once again, you should not expect to see capital gains yield equal to G, simply because there is no one single G. There are two different G's here. There is the first growth rate of 0 for the first 3 years and 6% then after. So not surprisingly, this is not equal to any one of them. If you want to think about it, It's actually kind of a weighted average of the two different G's. What happens if the stock has a negative growth of minus 6%? Would anyone buy the stock? And if so, what is its value? So first of all, let's understand what does it mean, negative growth rate. Negative growth rate means that the company is not necessarily dying. It is still earning money, but it is earning less and less every year. So 1 year it is earning $100, negative 6% rate growth rate. It means that next year it will still earn, but it will earn less, $94, and so on. So the company is still profitable, it's still paying dividend, it is still growing, but it is growing less and less every year. This is what it means. Let's see whether it makes sense to purchase such a stock. We can still apply the Gordon model. Although G is negative, there is no problem here. As long as G is constant, we can use the Gordon model. In this case, P0 is equal to D1 divided by Ks minus G. D1, just remember, it is equal to D0 times 1 plus the growth rate. So let's plug in the numbers. $2 is D0. 1 plus the growth rate, so it's 1 minus 6%, which gives you 0.94. Ks is 13% minus, and G by itself is also negative, so this is minus 6%. Notice that a negative growth rate will do two things. One, it will increase the denominator because you have minus minus here, so it will actually inflate the denominator. But on top of that, it will shrink the numerator. You need to multiply D0 times something that is smaller than 1, a fraction. So it will shrink the numerator and at the same time inflate the denominator. This will definitely give another discount to the stock price, which actually makes sense. Think about it. Negative growth rate, what do you expect? You should take a discount from the stock price. Okay? Do the math and you will get $9.89. Perfectly makes sense. Let's see what we had so far. With a growth rate of 6%, positive 6%, stock price was $30.29. With a zero growth rate, stock price is cut and became $15.38. With a negative growth rate, the stock price is cut even further and became $9.89. Everything perfectly makes sense. There is no problem to use the Gordon model, even with a zero, even with a negative growth rate, no problem at all. The only problem is when G is bigger than Ks, then we cannot have a negative denominator, because with a positive numerator, the price will become negative, which is nonsense. Let's understand what are the two sources of income under these circumstances. Capital gains yield is equal to G. Remember, as long as G is constant, this is the capital stock price appreciation. But in this case, G is negative. It is minus 6%. And therefore, it is a stock price depreciation. The stock price actually comes down. So when you buy a stock like that, you know that you buy it at a certain price and next year you will sell it at a lower price. You know that you will lose money on the stock price. However, if the company has enough retained earnings, enough to keep on paying dividends, then the dividend yield will be the complement to KS. KS is 13% minus G. G by itself is minus 6%, so the dividend yield is expected to be 19%. This plus that is equal to KS. So altogether you require 13% and you will still get it, but you will get it mostly because of the dividend yield. Dividend yield are very, very large. Once again, I have to say only when the company has enough retained earnings to keep on paying dividends. By law, companies cannot raise money from bondholders in order to take the money and pay to the shareholders. This is stealing. That's illegal. Companies cannot do that. Companies can only pay dividends from their retained earnings. So as long as the company is sitting on a large cushion of money, when they have enough retained earnings, then they can keep on paying large dividends despite the fact that you know that the stock price will depreciate. That's still okay because you're still being compensated and you still receive the 13% return that you required. At this point, we would like to move on and see other more practical approaches to evaluate equity. The first one that I will show you is called the DCF, after that multiples method, and the third one is called net asset value. Now, all three approaches look at the company as a whole, try to evaluate the company as a whole, and then from that derive the appropriate stock price, what is called the target stock price. The concept is pretty similar to before, but there are a couple of differences. First of all, with the DCF, we are looking at present value of future cash flows, but instead of looking at a single stock, where a single stock generates future cash flows of dividends, when we estimate the DCF, the discounted cash flow model, we first look at the entire company. So the cash flow of the entire company are actually free cash flow for the shareholders. The accounting definition of free cash flows for the shareholders is the firm's after-tax operating income minus the net capital investment plus the depreciation. Now, if you remember from accounting, the depreciation and amortization, it's not a cash flow statement per se, which means it does not actually subtract cash flow from the company. It has an indirect impact on the cash flow simply because the higher the depreciation is, the less taxes you will have to pay. But it's not a cash flow statement per se, and therefore we'll need to add it back. So the concept is, let's discount to present time all the free cash flow for the shareholders, and then this present value will be the value of the entire company. The final step will be to divide the value of the entire company by the number of shares, and from that we can derive the target stock price. Let me explain a few words about how to divide by the number of shares. The next few models that we're going to tackle look at the stock price as the total value of the firm divided by the number of shares. But there is more than one concept of how to look at the denominator, the number of shares. Number of shares can be either outstanding or fully diluted, and it really depends on the context, on the specific firm that you're looking at. So let's understand what each and every one means. The number of shares outstanding is simply the number of shares that is written for each and every company. That's a public information. Every public company has a number of shares outstanding. We know that it's recorded on every accounting statement. You can simply copy that. This is simply the number of stocks that this company is built from. That's it. That's the number of shares outstanding. Now, in some cases, you might want to consider to take the number of shares fully diluted in the denominator instead. What does it mean, fully diluted? It will take the number of shares outstanding, but then it will add also things that can be converted into stocks. For example, convertible bonds. If you remember, convertible bonds can be converted into a number of stocks. That's the conversion ratio, which is fixed and known in advance. Whenever a company is asked to convert its convertible bond into stocks, they will have to issue new stocks in return. And this number will be added to the number of shares outstanding. So number of shares fully diluted will take these things into account as well. Number of shares fully diluted will take one more thing into account, something that is called warrants. Warrants are also stock options. This is the same thing. Those are kind of options that will touch base with it just a little bit once we'll get to the topic of options. Those are stock options that usually are given as an incentive to employees. It's quite popular among high-tech companies. And then if the employees, for example, want to exercise their warrants, their stock options, then the company will have to issue new stocks as a return. So those are the things that will be added to the number of shares outstanding, and then you can figure out the number of shares fully diluted. It is slightly more complicated than what I'm explaining here. simply because you need also to add the probabilities. Not every convertible bond will be converted into stocks eventually. Not every warrant will be exercised eventually. So we also have to embed here the probabilities, but this is generally the concept that we calculate the number of shares fully diluted. It really depends on the concept. Some companies never issued convertible bonds. They don't have warrants. So all we need to do is take the number of shares outstanding. Other companies, they did issue convertible bonds. They do provide warrants or stock options to their employees. And therefore, it's better to work with number of shares fully diluted. In either way, whatever you work with, this will be the denominator. The concept is, once we'll figure out the numerator, based on either the DCF model or the multiples method or the net asset value method, we will finally have to divide it by the number of shares. This will give us the target stock price, the appropriate stock price.